Now what we're looking at here, of course, is just the basic power options suite of tools, and what we're looking at is a 14-day free trial. Those of you that are currently on the 14-day free trial, I encourage you to take advantage of the 4 steps that are listed here. You can get that free quick start guide sent to you or download it very quickly. There's some flash tutorials here to help you get more familiar with the tools on the site. We host a variety of free webinars during the week most of the time, so you want to join us for our live webinars. And of course, under the main home tab, you can access our archived webinars at any time. So there's a variety of archived webinars categorized by the tools section, various option strategies. You see things here on our credit spread series and debit spread series, calendar spreads, covered calls, straddles, naked puts, and more. General concepts of options trading, weekly options, managing a broken stock, options exercise versus assignment, Greeks, and so forth. And of course, all of our Friday discussions are usually posted right here in our requested topics section as well. So you want to make sure you take advantage of those 4 steps. And of course, any trial member or subscriber to Power Options can schedule a free coaching session at any time. We will walk you through the tools of the site and answer any questions that you have. All right, so it's getting started. Sam says, hi everyone. Sam's a regular here at our Friday sessions. He said, had a nice trade in Nvidia, the 158 calls today, sold 175s against it, and bought a 175 put to protect the gains on the calls for expiration next week and beyond. So Nvidia, of course, had some nice movement here. Let's just take a look at Nvidia. I'm just going to go to the quotes page here so we can see all the explanation of the stock there. Currently at 170.31. So he's got a gain in the 158 calls, and he sold a 175 call against it, protected it with a 170 as well. So sort of setting up a collar on a long call. Could look at it as a calendar spread. Essentially what Sam was saying, let's see here. So we've got some gain. I'm going to go to the custom spread tool. We'll take a look at Nvidia very quickly on the profit and loss chart. And we've mentioned that he had some October calls here, the 158 strike, I believe he said, the 155. Probably had some lower cost basis in there. Let's put that down at maybe $10. And then, of course, for next week's expiration or going into September expiration, got the 175 calls and bought the 170 puts as well. So we can, maybe I got that right. What we're doing here is taking the long call that has 80% gain in this case. I don't know what Sam's exact numbers are. Converted it in sort of a calendar to generate some premium, but also have the protection in place. So we can't lose any money on the position for the next 7 to 10 days, regardless if it happens over the weekend and more. Okay, so that's one way to look at it there. So different ways that you can structure, of course, protection, buying puts on long calls, maybe creating a straddle to help bulletproof the trade, or even rolling the call if you've got more than a 70 or 85% gain on the position. What do I mean by rolling the call? Let's say that we did pay $10 for that 155 call when it was at a lower price, and now the stock's moved up to 170, so we've got an unrealized gain. Well, to maybe guarantee some profit on that position, we could sell to close that call now. We'll call it about 18.20 or so at midpoint. I'm going to buy a 175 call at 6.15. We'll sell this, and I said 18.20. So I have an $8.20 profit on the position. And then we could buy the 175, the at-the-money higher strike call. So we're actually into a long call position with a credit of $195. Maybe I'd use the 170 in this case as opposed to, oops, hold on folks, there we go. Maybe I'd use the 170 in this case as opposed to the 175. But if the stock continues to move up, you still have further upside profit, but you can't lose on the position now. So you sort of protected the downside, and maybe I could sell in near-term September 175 and convert this to a calendar spread with no risk on the trade as well. So that's one of the other ways you can look to manage a call instead of adding a put to it as well. This is actually a webinar that's available, of course, back there in the free webinar section under the option strategies menu. Further down the list here, managing your long option positions. So we discussed techniques of how you could potentially manage a bought call or a bought put to help you lock in profits, or manage it if the call or put goes against you as well, some ideas of what you could do going forward. Okay? All right. Martin poses a question here. It's a good question, common question on a lot of people's minds. It says, some pundits think we are going to have a market crash. Besides just buying cheap puts, how could I set up a ratio spread to take advantage of this downturn if it happens? Are there rules for executing a ratio in a downturn? Okay, well, a ratio spread takes on infinite risk in one direction or the other. But then there are other things called ratio backspreads, which I don't know if exactly what you're talking about, Martin, but let's take a look. So, we think the market's going to turn. And I'll try to use SPY as an example. I know the premiums aren't going to be as good as what I'd want for a different strategy. But let's take a ratio call spread, okay? And this isn't the strategy I think you'd want to play. It has low risk, but a straight ratio spread takes on infinite risk if you're wrong. Pundits have been saying they've been looking for a market downturn for about 6 months. The market's been overbought for 6 months. But okay, you've got pundits you follow, Martin, no problem. So let's see. Let me go back to your main question here. Going to have a market crash. Okay, the first thing we have to consider, Martin, is when is a market crash going to happen? You think it's 1 week? 5 weeks? 3 weeks? 20 weeks? Within the next 3 months? There's the debatable question. Timing is everything if you're trying to play a bearish play. Now, a bearish play would actually be a ratio call spread if you could get it. Well, one of them. But it would be a ratio call spread is one way to approach it. But it's not really what you'd want to do for a market crash. Let me go out to October, 49 days away. Let's give us some time to see if this crash develops. Okay? I'm going to do a ratio call spread if one's available. Let's see here. And I want to do 250 to 248. But I probably want to do 246 and 249. Okay, so a little bit in the money on the call that I'm buying, and I'm going to sell 2 higher strikes. Why is this considered bearish? Okay, so we buy 1, and we're going to sell 2. And I'm not going to worry about midpoint prices. We're just going to go with this here. Okay? So, what I've got here is a ratio call spread. Why is there infinite risk to the upside? Well, because I sold 2 higher strike calls. One of those is a naked call. Okay, so if the market continues up and it goes against me, I've got to manage that short call. I've essentially got a bull call debit spread. Long one SPY at 246, short one SPY at 249. But here I entered a ratio spread with a small credit, which means if everything falls, if it goes against me, I can still make a small profit. Okay? And if it stays right around where it is now, 247, 248, I've got a reasonable profit range as well. The risk is if it goes the wrong way. This isn't the bearish play that Martin's looking for. Okay, this is just a standard ratio call spread, which obviously you would never do on a bullish stock because of the risk of the upside. I'd also never do it on a stock that has earnings coming up between now and expiration. Okay, and I know you want the opposite trade, Martin, but I'm showing this as an example because some investors will, during our spreads webinar, some investors brought to our attention that this is a spread position that carries little risk. No, it carries infinite risk, okay? And the investors will look at the ratio spread, and we'll talk about the ratio back spread you want to see in just a moment, okay? But what I'm looking at here is a customer will come in and say, well, look, the stock's at 247, and you could make $312 on this position. It's a leverage position, but again, you have a short call, so you've got a naked call, excuse me, you've got to cover that margin. But the common thing is say, look, you've got an 85% success rate or higher on this position. There's only maybe a 15 to 20% chance that the stock would be above 252. So you've got essentially an 80-85% chance of success. Yeah, you could say that there's a 39% chance the stock would stay in this range, let's say in this block area. There's a 29% chance it'll be in this block area. There's a 19% chance it'll be down here. Okay, so you add them all up and you say, okay, what's that 80% chance of some probability? Maybe 19% up here too. Any case. But there's only a 1% chance that you're going to make that maximum profit on this ratio call spread. You might make a profit here, and that would be pretty good, half of what you expected. But if you're opening multiple trades, you've got 10 or 12 of these ratio spreads in your account, and let's say 80% of them, or 8 of those 10 or 12, end up in this range, which is still probably about 60 to 55% chance it'd be in this range, you're making 12 cents. So I do 20 trades. 17 of them end up with about a 12-cent gain. One of them ends up with a $3 gain. One of them ends up with half of that at $1.50. And then one of them had a surprise, and it went over here and had a $350 loss. You're right 90% of the time, and you didn't really get ahead. Okay, that's just what I wanted to bring up about the standard ratio call spreads, not what Martin's asking. But some people are sort of under this idea that when you look at volatility cones and you look at probabilities that, well, there's an 80% chance the stock's going to be in this range. Yeah, but you don't really want to be down here. Sure, you're not losing money, but you're barely making enough to cover commissions depending on how many contracts you're trading. And if the bulk of your trades are making this amount and still one goes against you to this amount, with one here, you're essentially coming out at break even, being right 90% of the time. That's why I don't like people saying that ratio spreads are fairly safe because there's such a high probability of making some profit. But I don't want to have the high probability of making that profit. All right, but what Martin wants is reversing it. And what we want to take a look at here is the ratio backspread. Remember, in this spread I sold 2 and bought 1. I could reverse this with the puts, but what Martin wants is a low-cost position where, on SPY, for example, I would convert this. I'm still going to go out to October to give us, again, that 49 days. But I'm going to buy, let's get around the money here. I'm going to buy, oh, I don't want to go that low. Okay, maybe I'll go to 246. But what I'm going to do is buy the cheaper put and sell 2 of the higher. I'm sorry, I'm going to buy twice as many puts as I'm going to sell. Okay, so I'm going to buy 2 of the 246s and buy 1 of the 243s. Okay, so buy 2 and sell 1. Oh wait, I'm sorry. No, short. You want to do it the other way. Okay, sorry. Let's short that one. I'm going to short the higher strike and buy 2 of the lower strikes. Okay. So paying $217 twice and getting $289 on a roughly a 3-point spread. Okay. So now here again, we probably got to go to higher strikes to make this worthwhile. Why do I say that? Number one, it's very hard on a ratio backspread to get this where you want in the profitable range. You'd have to do this at a credit, and normally the backspreads won't be done at a debit, so you can lose up here. I don't like the fact that this break even to start making profits at 238. Sure, if the market pulls back, that's about a 10-point loss on a $250 stock. So we're about 5%. I don't know if that's the crash we're looking for. Okay, so let's change our strikes. Let's make it a little bit better. I'm going to go closer to at the money, actually. I'm going to look for some better premiums. We're still going to go out to October, of course. All right. So what I need to do is find a cheap put spread. Now, if you're expecting a large crash, you may be able to go cheap. And what do I mean by that? I might be able to, let's do the 235s to the 240s. And again, I'm going to buy 1 of the higher strike. I'm sorry. Sell 1 at the higher strike, buy 2 at the lower strike. Now my debit's only 50. That's pretty good. But because I chose the lower price to get the lower debit and the wider strikes of 5 points, if the stock falls to 235, ETF I should say, 12 points, you're at a loss of 235. You won't make a gain until you're about at 228. Okay, this is where the structure becomes difficult. So you've got to figure out, based on your expectations and your target, if you think the stock's going to be around 235 or so with a crash and might drop a little bit lower, this is not, this particular trade with these strikes and these prices are definitely not for you. Okay, you're trying to get infinite downside and hedge the loss. Okay, so once again, go back to October, and I'm going to do a 248. Got to keep it close. I got to go 245. Okay, so we're going to sell the 245 that's just out of the money and buy 2 of the higher strikes. It's a debit of 401, but you see now we're getting that break even closer to 246. Okay, but the debit here at top is still sort of a loss in that situation. You know, so you bought 2 at the higher strike, sold 1 at the lower strike, and you can structure it different ways, but this structure here, I can lose the 401 if the stock goes the wrong way, but here going in the money actually and selling the one out of the money gives me a risk reward profile where my break even is lower, and of course the max profit's not infinite, it's only infinite to 0. Okay, so as long as it keeps going down. But I think that to me is more of a better structure where I'm buying 2 that are at or maybe even slightly in the money, and I'm selling 1 that's maybe 2 to 3 strikes lower to still get a decent premium on the position. Debit is the most you could lose in the trade, and the break even is closer to the stock price. Okay, so going out of the money, looking at cheaper options, I don't think gives you what you want. I think you've got to look at the higher priced options at the money, the ones to buy, the higher strike to buy, to get you to the break even that you want, but that depends on the structure. Okay, and that not the structure so much, that is the structure, sorry Martin, but that returns it the other way. Okay, now Sam brings up it was Sam brought up a comment, I believe, and it's something that I like to do as well. Okay, Sam says in relation to this, if you're expecting a crash, what Sam likes to do is buy UVXY, which is one of the volatility ETFs. Okay, so he'll actually buy shares of UVXY. In terms of a market crash, what I've been doing in my portfolio, many of you know, of course, that I already trade with protection with about 50% of my account. 50% of my trading account is into the radioactive trades, which already guarantee I can't lose more than 4 or 5% on any one position. But I'm going to have 10% of my portfolio in some speculative spread trades. 10% of my portfolio trading some long straddles on the earnings plays, but those are also protected because if there's a market crash, you know, I'll still be making money on the put side of the spreads even if earnings hasn't occurred yet. I'll have some calendar spreads, calls or puts, of course, and my credit spreads will have bull puts or bear calls. And I'll also have maybe some long options that I'm looking at bullish long term, but also trading as calendar plays as well. But the portions of my portfolio, bull put credit spreads, long calls for calendar call spreads and things of that nature, anything that's bullish, I'll hedge that portion of my portfolio by buying calls on the VIX. A little bit different than what Sam's saying. Oh, sorry. But with the calls on the VIX, what I'm able to do is kind of go further. I can go near term, but I can go further out in time. And, you know, with the volatility index right now at about 1020, 1030 or so, 1013, I can buy a cheap call, 20 calls for maybe 50 or 60 cents. This is a way of also buying the puts, the cheap puts on SPY, for example, as well. So, oh, sorry. I'll buy 10 at 0.55. Now, the trick with the VIX, Sam's talking about buying UVXY, which in itself is an ETF that doesn't have a set expiration date. And another issue with the VIX is that the calls aren't really priced intrinsically. Okay, it's not what you think of as a normal stock. Let's look at that chain again. For next week, next 2 Wednesdays out, September 13th. They expire on Wednesday, by the way. And so when you look at some of these, the in-the-money puts here, with the stock at 1013, remember the ETF is currently at 1013 for VIX. The 11 strike put's only priced at 25 cents. Okay, well you think, well, it should be 87 cents of intrinsic value. Well, that's not really how it works. It's based on sort of the future-looking volatility, not on something that has inherent value. And that's sort of hard for investors to realize. But remember the last time around August 9th, August 10th, when the market turned and the VIX spiked, well, it went up from about 10 to about 22 in just a one-day period. It was a Thursday. How do I know it's a Thursday? Well, because I had bought the VIX calls that expired that Wednesday that ended up expiring, and then the next day, poof, they went up. So I rolled them. I didn't just let them go close. But let me go back historically, just on the VIX for a second, and then we'll look at UVXY. So I'm going to go back to the VIX chain, and we're going to go back to August 1st. Okay, we're going to go back historically to August 1st. Okay, and I actually did this before then. Yeah, let me go back further. I apologize. Let me go back into July. Let's go to the 24th. Okay. Now I got to go to August 16th in this case. So on July 24th, the 20 strike calls I mentioned on the VIX were worth about 12 cents. Okay, so what happens when the market turns? Volatility is going to increase, and so this spikes up. So on July 24th, I could have bought the August 16th 20 strike calls on the VIX for 12 cents. Now, what happens on August 10th, I believe? I bought mine, of course, on August 9th, so I missed the first round and I had to make it to the second round. But you see the volatility went up to 1604. It was up $4.93. The 20s went to $1.10. Okay, so we paid 12 cents in, and they go up to $1.10 with that movement. Okay, and I don't know if it went higher the next day. I don't remember. Let's go to the next day, to August 11th here. No, it started to settle back down, but the 20 calls were still worth $1.15, and we paid 12 cents to get in. So that's another hedge if you're thinking about a big drop, or a way to hedge part of your portfolio if you think there might just be a one-day or two-day trade. What was the drop on SPX on that day? Well, let's take a look. Let's take off the VIX here. All right, so we saw it go up to 1640. It went up 494 to 1640 roughly, I think it was. It's around 1640, but our 20 strike call would have gone from 12 cents on July 24th to $1.15, let's call it, $1.20. Now on that same day, let's go back to August 10th. It recovered the next day. SPX recovered the next day. But it was down 1.45% or $35. Okay? So, yes, this moved down 35 points or $3.50 what the SPY would have dropped down. But the VIX moved up $4.94. And again, I didn't get intrinsic value, but that 20 call moved from 12 cents to 15 cents as well, okay? All right, so that's another way to hedge that, is by buying UVXY. Okay, now let's take a look at that same thing. UVXY, it's the ETF, so we'll just buy shares of it. It was up 863 or 26.72. Okay, it cost $40.93. It was up from 32 to there. But let's go back. Got to make a fair comparison, don't we? July 24th, Oops, sorry about that. 2870. Okay. I'm going to talk about what if we invested, well, I don't want to use same amounts, but let's say we'll do that. 2870. Okay, so on July 24th, when I got into those VIX calls for 12 cents, let's say I would have bought into this at 2870. And then as we saw going forward to the date of the move, August 10th, we go up to 40.93. Okay, so we go to $40.93 on the trade. So you've gained $12.23 on a 2870 investment, almost 50%. Okay, 49%, almost 50%. So let's break down some numbers, shall we? If I was going to invest $3,000 to hedge, let's say a $300,000 portfolio, we could have bought shares of UVXY at 2870. All right, so that would have been 100 shares. And then when we got the move, we closed it out at 40.93. Okay, so you make the, what did I say, $12.23 or $1,223 on the position. All right, now, hold on one second. There we go. Now I do the same thing, but let's say I had a $300,000 account, and I was going to allocate $3,000. Ugh, that's not going to be a good number, is it? Well, because I would only pay 12 cents per contract, I could buy roughly 2,500 contracts. I believe it was. Wait, let me see that. Let me do that again. 250 times 0.12. Yeah, it's not going to give us 30. Okay, so I apologize. 1 second. Just working out the math here. Yeah. Okay, so it'd be 2,500 contracts at 12 cents. Whoops, no. Jeez. I divided by wrong. 250 contracts, okay, at 12 cents times 100, right? So it'd be 250 times 12. That would get us to the 3,000, okay? Now, at the end, remember we paid 250 contracts at 12 cents, and then we'd sell the 250 contracts for $1.15. Which takes me up the 250 contracts to about 28,750. Okay, so that's the lie of leverage working for you. Let me make sure I did that right. I'm sorry, I did not do that right. Jeez. Yeah, no, that's right. It'd be about worth 28,000. So the VIX calls can give you that little extra bump in those large swings. But again, we were looking at almost a 2% drop in the SPX, which doesn't happen that often. Okay. And that's what we kind of look at. Now, Sam had also said if there's a 20 to 30% crash, then I'd buy long puts on Tesla or Netflix, and you can do good on them. I kind of like these SP ones as well, okay? You know, the VIX options and using UVXY rather than those on the stocks. If you own those stocks, sure, buying puts is expensive, but it's also the best insurance you can get one-to-one, okay? And that's the case as well. Now, Martin brought up another point just to look at with these ratio spreads. He says, look at the opposite, and I think this might have been earlier. He says SPY is not such a good example. I understand that, but you're talking about a market crash. On this day, on August 10th, there were stocks that were moving up as the market was falling. And I'm not just talking about inverse ETFs. There were stocks that had earnings that day that moved up. And, you know, they were still going strong. So if you're planning on a market crash and you're planning on a strategy to take advantage of that market crash, it should be on some broad-based index, ETF, or something along those lines. Doing a ratio spread or any kind of bearish play, and this is something I just mentioned, but I kind of disagree with Sam on, buying puts on something like Tesla or Netflix, yes, they tend to follow the market. Yes, they're bigger market caps, that they're way up there and so forth, okay? But there's no guarantee that they're going to have the same type of drop as the rest of the market. They should pull back. But if Tesla releases good news on the day the rest of the market pulls back, its loss is going to be muted. Now, what are the chances of that? I don't really know. I don't want to get into the discussion of the probabilities or whatnot. But if you're planning on a market crash, you should be focused on something that takes the market with it, that goes with the market. And those are your broad-based indexes and ETFs, okay? So Martin wants to go back to that other one. Now remember, I was finding ones, ratio backspreads, that gave us the structure, and that's what we had. We had sold the 248, I believe, and bought two of the lower, okay? And you want to get a credit, but it's usually pretty difficult to do that. Okay, here's the loss of 227, the loss of 427. Again, 241 is much better than that one we saw at 247. But remember that other structure I had the break even at 246 and the infinite to the downside. Get to break even sooner, and the risk wasn't as high. Okay, so what I was saying there with that ratio put spread, the one that I think we had done is that we had actually bought two higher, and sold one lower. And it's, I agree with you, this isn't the structure you're necessarily talking about. It's a ratio spread, but you get to break even faster. The risk is about the same, and it's only if it's up here. Down here, you still net those profits. And here you've got the 246 short strike. You've actually entered a bear put debit spread with an extra long put at a higher strike, so you get a better break even. Okay, I know this isn't the structure you're talking about, but look at this graph again. Break evens at 245.72. Max risk is 428 if SPX is above 250 or 248 at August expiration. And let's go back to what you were looking at. Okay, it's where you wanted to what did you have here? I'm sorry. Sell the higher. So you want to sell the 248s and buy two here. Okay, so remember, I know this is getting confusing. It's hard to explain, but in this structure here, I'm buying two of the higher and selling one of the lower. It's a bear put debit spread with an extra long put, cost of 428 into the trade. Max profit 24,572. The max risk, only if it's up here above 250, is 428. Same strikes, reversing the structure. Selling one of the 248s and buying two of the lowers. I do have about half the debit on the position. So if it's up here above 250, I only lose 227. That's the difference. But the max risk, if it's right around 246, is about the same. And you have got varying ones in between here. But the break even's at 241.73 instead of at 245. Profit, 24,000. Yeah, if it goes to zero, but $300 difference in the max profit. That's irrelevant completely, because SPY is not. If SPY went to zero by October 20th, we'll have many more larger problems to deal with than if we decided to do this ratio spread that Martin's looking at versus the ratio spread I saw, which is still a ratio spread. It's still a 2-to-1. It's just a different structure. And I think that structure gives you the benefit of having a closer break even. Get to profits faster, where this one, yes, if it goes against you and it stays above 248 and it keeps moving up, you're only losing 227 as opposed to the one I showed at 428. But if it drops just a little bit, or even if it drops to 242 and then comes back to 245, you're still, let's see, you're 244, 245, you're still losing about $350. Whereas at 245, we were at break even on the other structure. Okay? So think about that when you look at it. And the cost is different, and the trades are different as well. and so forth. And so that's what kind of gives you that. Now, Sam brought up another point in relation, I'm sorry, bouncing around here, but to that UVXY. The one advantage of doing the ETF, for example, the two ETFs you might consider, one's an ETN. But if you look at the ETFs in that case, one of the advantages is when he saw that large spike in UVXY, he's got a couple other opportunities to manage it. Now, I had a call on the VIX, so it moved up. I could have, bought a put against it and created a straddle, but the leverage comes into play at that point. I could have sold calls against it, but the leverage comes into play. When you own the ETF and it has that move, you can protect it with a put to guarantee profit and then trade spreads off of that ownership. You can kind of do more without increasing your margin requirement because you own the underlying. So whereas I might try to sell a call against my VIX call to create a calendar spread of some sort, but remember I was very short term. That's the other advantage of the ETFs over using volatility calls or inverse volatility calls, is the fact that when you buy shares of the ETF instead of the option, of course, when you start selling things against it or doing other adjustments, you don't have to worry about margin requirements. Okay, you don't have to worry about that because owning the stock is controlling it. Okay, all right. All right, so now Martin wants, we'll go back to that discussion in a moment. And Martin wants to talk about going to VXX on a bearish play. We think the market's going to crash. So we're going to go back to VXX. VXX is the ETN I'm referring to. It's one of the other ones that will have movement. It's muted, I've found, compared to the movement of the VIX, and as UVXY I think moves a little bit more than the ETN, the exchange traded note of VXX. That's all right. But Martin wants to look at selling the VXX 38 put and buy 2 of the 36 puts. All right, so about 55. Let's see here. You call it 61. Good. 61 and 25 are the prices you want to use. Okay. Ah, shoot. Make sure that gets in there correctly. There we go. All right. So we want to sell the higher strike at 61 around midpoint. I'm going to buy 2 of the lower strikes, 25. All right, you get a net credit of 11 cents, loss of 189 if it falls a little, falls into this range here to $36, I'm sorry, at the strike, and then the second break even clicks in at 34. Okay, so you get 2 break evens. Here you're at a profit of 2 cents. 11 cents here is the credit. So what is your crash? What do I mean by that? We didn't look at VXX. We're going to have to do that right now because we're going to have to look at VXX the last time, those same time frames there was that movement. Okay, so let's go to VXX chain. There we go. And what I'm going to have to do is go back to July 24th. Good. It's at 11:01. Fantastic. And then I'm by August 10th. Jot these numbers down as well. Okay, so on August 10th, it only moved 1.5%. With that 1.5% move, we saw the VIX move $4. We saw the UVXY move up to $40.93. Not all at once, of course, but it got to that point. The VIX, the VXX moved from 11:01 to 13.29, $1.59. It was moving around before then, but it moved up $1.59 at this point with that 1.5% movement we saw in the stock, or about 13%. We saw more leverage movements and percentage moves. Why is this relevant? Okay, because I really want to know if you think the market's going to crash in this case. All right? And remember, this is a spread you could do, but this isn't what you'd want to do if you're bearish. That's the key, okay? If you're bearish and you think the market's going to crash, VXX does not drop. VXX goes up. So we'd want to do this with the call structure, not with the puts, okay? We'd want the one that has the infinite upside in this direction. But remember, it moved percentage-wise almost with the market, didn't it? We saw a 1.45% drop in SPX, which translated into a $4 movement on UVXY and about a $4 movement on the VIX, but it was only about a $1.59 movement on VXX, okay? So this structure doesn't help you because VXX is the inverse. It goes up when the market goes down. Okay, so this isn't this. You don't want to do this on VXX. You do it with the calls to get the infinite upside. Okay. Yeah, and Martin says you only do these as a credit. I get that. But again, let's substitute out the fact that this is an inverse and the fact that you're bearish. So you wouldn't be trading puts. You wouldn't be doing this spread on VXX to begin with. Okay, you'd want to be using the calls to have the infinite upside that direction, okay? Because VXX is an inverse if there's a crash. But again, this goes back to, well, isn't this a safer trade than the other things that you teach? Because there's an, let's call this, I'll be nice. I'll say 80 and I'll say 10. And I'll say 10, okay? So there's an 80% chance that you're going to have a small profit. There's a 10% chance that you're going to have a loss. And there's a 10% chance that it could really fall if it does fall based on what the pundits are saying, and you could have this infinite gain. Now, let's ignore that this is VXX, actually. Just take this as a standard stock. Let's say this was the spread on SPY, where this would continue to have further profit. But again, if you're only making 11 cents 75% of the time, 5% of the time you get astounding ones, but then another 5% of the time here, or 10% of the time, you're somewhere between a loss of, you know, the 100 to the 300. I don't think it might be profitable long term, but remember, this is barely covering commissions unless you're doing a large amount, okay? Yeah, and you would, okay, so let's look at Tesla. Martin's saying a better way would be to do Tesla here on this, but you kind of see what I'm getting at with these. There's so many different ways to structure them. You have to take into account first, what is your expectation of the decline? If you're planning on a decline, what do you think the percentage movement is going to be? And then which instrument hedges your portfolio the best based on the expectation of the movement you think is going to happen? I think it's going to be a better hedge to use the VIX calls or to use the UVXY. There's other 2 times and 3 times VIX ones are volatility movers out there as well. But let's look at Tesla, okay? And let's look at the puts there on Tesla. I'm going to go October 20th again. All right, and I'll try it this way. 360s to 3. I just did that wrong, didn't I? Right, okay, let's see here. Go back up. Yeah, okay. Oh, okay, yeah, so you did mean the calls, Right, so yeah. Yeah, okay. Sorry, I'm just looking at the other comments coming in. Yeah, we were talking, Martin would have used the calls in the VXX. I do apologize for that. That's what he was looking at there. And, you know, to do the proper structure to get the credit here on TSLA, it's going to be a, whoops, wow, it just locked, sorry, there we go. Just sort of locked up on me there. Okay. Sorry, Martin's saying that the strikes are too far apart. Well, you could go shorter term. Let's go to the October 6th. Oh, okay, I thought they'd give it. No, they do. They do. Actually, they do. They give you 250s here. And, you know, you see the numbers, though. There's some that are pretty close to being able to do it. Not exactly, but yeah, they're kind of wide apart. So, to me, I'm just going to state it again. Sam's commenting that he had great returns during that flux of August 10th I was talking about on Tesla, on a couple of other positions as well. Looking forward to you know, what adjustments he made on those trades. And a Momo is a volatile one that, you know, could be traded, but it had its own little problems today as well, or this week I should say, and so forth. Excuse me, folks. But the idea, again, really, if you're looking for an overall market correction, trade a position on something that's going to move with it or move counter. Easy search to do on that, or easy idea to see on that. Let me go to long calls, which I don't have. Okay, that's fine. I'm going to go to married puts. No, I'm going to have to add long calls. It's just easier to use as a stock screener. Take out iron butterflies. There we go. Okay, so what I'm going to do here is we're going to go to the back test. And I'm going to go to Smart History, which is our back testing. It works with the search the same way. So I'm going to go to long call, and I'm going to search on August 10th. And I'm just going to use this search, but I'm going to change it. Okay, so ignore this default search I'm using for now. That's just nothing. And the back testing is going to take a while because we're uploading all of the historical data from the close today into the system. So it takes a little while when we're on the 4:30 webinars, and I do apologize for that as well. Other comment Sam made, though, is that for the last 3 years I'm hearing someone comes on TV and says the market is going to crash, but it's been overbought for the last 4 years and so forth. Okay, and that's kind of a lot of things there. Now, what do I want to do here? August 10th, the standard expiration was the 12th or the 11th, I believe. So I'm just going to look at 0. We're going to keep our search on August 10th, but let me clear the filters. I'm going to look for just options that expired on that Friday. The 10th was a Thursday. We're just going to look for ones that expired that Friday. I only want positions that were one strike out of the money, so I don't see a lot of duplicates. I just want the one strike there. I'm going to look for some that had volume and open interest. And I'm going to remove the inverse ETFs. Okay, the counter market ETFs. Why? Because what I want to do is look for just simply stocks that moved up greater than, I'm going to start off with just 0%. Okay, stocks that had a positive 0% gain over that time. Okay, and the reason why I'm doing this, let's just see. I might not even find anything. So August 10th, for things that expired the 11th. Nothing major. Okay, that's good there. Newmont Mining was up 34 cents the day the market was down. Oh, I didn't take out the gold, of course. The 3 times ETFs were up. I was going to take those out. Silver was up, of course. MBIA, Snap, positive earnings the day before, and Perigo. So nothing really major. We see here there were some bullish stocks. There's actually 34 stocks that were moving up. This is just looking at the top 10. So let me do this. Let's clear this out. Instead of the inverse ETFs, let me just remove all of the ETFs. So we're not looking at the gold or silver that were rushing up when everything was coming down. Steel, Sam says, probably would have been going up today too, this day too. So this was on August 10th when we saw everything going down as well. There we go. Perigo, Wheaton Precious Metals. We saw Snap, Newmont Mining, McDonald's. That's kind of, see, IBM, Coca-Cola, and then the gold as well. Monster Beverage, not one you'd think of. But these are what are considered safe havens. Now, why do I say that? The stocks that that were being mentioned of, oh, we could trade a bearish play on Tesla if we think there's going to be a market crash, or Netflix, or something that follows it more. Well, these big boys here usually tend to follow the market. and they were up that day that the SPX was down, the VIX was spiking. Right? Maybe related to earnings, maybe related to other news, it doesn't matter. To me, that's the risk of trying to play a standard stock like this for a full market downturn, because sometimes stocks that you think just move with the market and have low volatility, McDonald's, IBM, Coke even, Coca-Cola, may actually do the opposite of what you expect. And the market could be falling. And for whatever reason, news or whatever was out there, these stocks were actually moving. It's a lesson I learned many years ago during one of these webinars, 3 or 4 years ago. It was a poor gentleman who thought there was going to be a market correction, and yeah, he double whammied himself. He thought there was going to be a correction, and so he bought. This is a little bit different. I'm going to counter to what my own thoughts were. Well, what he did is he hedged his portfolio with GE. Okay, so he bought some shares of GE and calls on GE to hedge his portfolio because he thought it was a good market indicator. Well, what ended up happening is that he didn't see the crash that he wanted at all across the market. The market kind of stabilized and was just kind of hanging there for a couple of months. But that's when GE sort of lost about 15% in the 2-month period. So everything he put aside for insurance, he lost nearly 100% on trying to play a downward market. The problem was his insurance he bought went down to zero, and the positions that he had that he was worried about protecting kind of just stabilized and did nothing. Well, that's what can happen when you do insurance. But the lesson here is had he done the reverse and bought protection on SPY, let's say he bought puts on SPY to protect a large GE position, which another customer did, what happened was, well, 70% of his portfolio, I think at the time, was in GE. And in the reverse, you know, if you had 70% of your portfolio in GE, you bought puts on SPY to protect it, GE falls, and your SPY puts also fall because it's stagnating. It's not moving one direction or the other, so you didn't really protect anything. That's why the better direction, not better direction, but the better protection, of course, is individual stocks. And if you're planning on a market crash, you should be looking at some of the volatilities and some of the volatility indexes, volatility ETFs, or maybe straight out puts on SPY and so forth, because that's what's going to move. There's no guarantee that even market stocks that follow the market, Apple, Amazon, Netflix, Tesla, things of that nature, it's no guarantee that they're going to drop when the rest of the market's dropping based on what's going on with the stock at that time. Now, if you're bearish on Tesla, absolutely, load up on it. Buy some puts, keep your allocation, trade a bearish ratio spread or something along those lines. Absolutely, if you're just bearish on that single stock. But if you're looking for a market crash, focus on long positions, bullish positions on the volatility ETFs and indexes, or bearish positions, even bearish ratio spreads that Martin's talking about that we looked at a couple examples of, on a broad market ETF or index. Okay, make sure that you're following something that's going to move with the market, not that could go counter to what the rest of the market was doing. Remember, this was on August 10th when SPX was down 1.5%, about 38 points. We're seeing big names of McDonald's, Weight Watchers, IBM, Coca-Cola. Of course, the gold is up, Monster Beverage as well. Snap was up, but that's just because of the earnings. These might have been too. But what we might consider 3 or 4 big market stocks, large cap stocks that would move with the market, did not and moved counter. Okay, so that was on August 10th when we saw everything fall. Those were the stocks that were up now that we've removed the indexes and ETFs as well. Okay, all right. Maybe I have to, oh, well, Sam, I'm sorry. Oh, yeah, no, weaker stocks are going to follow it even more. What was the Ambarella? Hammer today, down 22%. So if there's a market correction next week, I'm not saying there is, but if there's a market correction next week, don't be surprised if that drops another 8, 9, or 10%. It would be disastrous for the stock, but I mean, the weaker stocks are going to reflect more weakness as the market goes down on the whole. Okay. Yeah, and as Sam mentioned, he's in UVXY calls for October, and looking for a spike on Tuesday. You won't see one on Monday, of course, Sam, because the market's closed. So that's that as well. Also, okay, so yeah, I'm going to work on some of these numbers for you over the weekend. I'm gonna do some stuff here. I'm going to take a look at the different ideas of things that moved on that day. UVXY, VIX. I won't go into the 2 and 3 times because, of course, there is a 2 or 3 times ETX as well that follow the volatility with that. And to look at some of those different structures and some of those different numbers, Martin, too. I'll have time to do that hopefully on Monday. We shall see. Yeah, I want to go through that, and then we'll talk about that a little bit next week, not on the Friday session. We'll do some write-ups and we'll do some blog articles there on some of these ideas. And it is important, and it's something I want to do. You know, we wrapped up the spread series. I was working on some other stuff this week. But one thing that I think is important, because I get asked the questions just as Martin's doing correctly now, and whether I think that 6 to 8 months ago there was going to be a correction, and then 4 months ago, and that Ernie and I have been saying to each other as we pass in the office sometimes, like, yeah, I've got calls on the VIX. I bought calls on the VIX because I thought there was going to be a little hiccup, a little correction. Not a long pronounced one, but I thought there was one. I was right. I just missed it by a day. You know, it was July 21st or 22nd. I bought the August 9th calls on the VIX. I bought them for 38 cents. I sold them for 5 cents that day before the market, 4 cents before the market close on Wednesday. And then Thursday, it was the 20 strikes. And then I sold them to close them, got something back, and then I rolled them out to the 20 strikes for the 20, whatever it was, the 23rd or the 22nd, I can't remember. And then, of course, on the 10th, it spikes up to 16 or 17. Okay, I did profit. But remember, I added double the cost. It was more than double the cost. I think it was 12 cents that I paid out originally on those, and then I had to pay, I think, 35 cents for the 20s for the 22nd, and it spiked up, and I was able to close out for about $1.20. So I still made a profit on it, but that's, well, okay. All right, so Martin, I'll pass that information along as well, and we'll talk about that soon also, but I'll take a look there also, okay? And this is one of the things I was going to talk about. Sam just mentioned another comment, and his comment was, if you have big gains on SPY, DIA, IWM, that maybe you bought before, around September, around November, before the election, just after it, you could protect it with UVXY. But you have to have the correct correlation to protect to positions, and you like stocks because you don't have to worry about it. You're exactly right, okay? And one of the free webinars we have, I think it's under Options Concepts. I really hope it is. It's an old webinar, which actually a gentleman that used to work with us, Mike Phillips, I believe, co-hosted with me, or this is the one I did by myself. But this is the stock or portfolio insurance. You know, how do I protect my portfolio? Do I buy puts on an index or ETF? Do I insure my positions directly? What about calls on the VIX? So we break down sort of the pros and cons of each one. And what gets really, really annoying, what Sam mentioned, is you saw it already. You know, those VIX calls I bought to hedge against a downturn were only worth 12 cents. Well, now I've got to face a choice. How much of my portfolio am I going to try to protect with VIX calls? If I try to protect the entire portfolio, I might be buying 3,000 or 4,000 contracts at 12 cents, which might be very lucrative. But the commissions now are going to be something I've got to consider as well, because it's not a direct correlation. And someone always says to me, well, I've got a $500,000 account, and I would say that roughly $412,000 of it is in SPY. How many puts do I have to purchase to protect, how many SPY puts do I have to purchase to protect $412,000 of investment to make sure I don't lose more than 5%? Well, the minute you tell them that even if they buy at the money puts, and they don't want that, they want to buy out of the money puts for cheaper costs, but you're in the tens of thousands of contracts, right? It doesn't protect one-to-one, you know? And so that's what you have to reconsider. And again, what we just showed, SPY could, stocks in the SPY can drop, and the SPY could stay the same. Not all stocks, but a group of stocks could fall in SPY, some of the big ones due to outside events, and SPY could stay the same, which means you're still losing on your stocks and you're losing on the insurance that you purchased. You know, and that's where you go as well. And so that's the trade-off, is that when you say that, oh, I don't want to lose more than 10% of my portfolio, I've got $400,000 of $500,000 invested, how much money do I have to put up to buy puts to protect, let's say, 90% of that value? Well, you're probably putting the rest of that $100,000 in minimum that you have left in cash in your account to protect 90% of that. You know, Sam says he's got a $10,000 account, and he's got about 10K in protection with puts and inverse ones as well. But yeah, take a look at this one, and you know, we do discuss how much you'd need to buy for the ETFs and so forth, but there are cautions with it, and the cost you usually think of, how much it does cost you to even just buy puts or buy inverse calls, I should say calls on inverse ETFs and so forth that would gain in value as the market fell. If you're planning on trying to protect 80 to 90% of your portfolio, the stocks in your portfolio, the amount of capital you're going to have to put up to do that is probably not what you're considering. Okay, and yeah, Sam says he has 30% in spreads and 10% in speculation as well. So I mean, that's sort of the crossover there with that too. But there's a webinar you can access, stock or portfolio insurance. Why did I mention that I'm going to go ahead and why do I want to go over these numbers and go over this discussion we had with better numbers, clear picture, maybe a full webinar? Because whether or not there is a correction, I think it is time to revisit this video completely fresh with new alternatives that are available. Keep in mind, the things Sam's talking about, VIX calls were available, but all these 2 times, 3 times volatility ETFs and so forth, I don't know if they were available 6 years ago. The VIX was, but then it expanded. There were ETFs that represent portions. VXX was. I remember that. VXX was available in 2011. But some of those other securities might not have been. And that's the same thing. And then Martin commented that hedge funds buy cheap options and call them units, 10% each rather than buy them outright. I was trying to set up selling 1 put and buying 2 to 3 below that to hedge some of the costs, and the same trade could be created with a call side, maybe 1 to 1. But yeah, maybe, I'm sorry, what he was saying is that using those ratio spreads on the puts to hedge some of the costs, some could be created on the call side to get closer to a 1-to-1 risk-reward ratio, then a call credit spread to offset the vulnerable side. Yeah, but now, as a whole, remember, if you do sort of a bear call spread to the vulnerable side of the put ratio spread, if something went up instead of down, you can lose on the bear call in the worst case scenario, so it would take a gain to a loss. I think I understand what you're saying in that regards, Martin, and you're trying to get an extra credit being out of the money in that situation, get an extra premium to help lower the maximum risk in that V point on the put side. But then, of course, if you're wrong and it goes up, then you wouldn't have a positive net credit. You'd have to pay the loss on the bear call side, and so you wouldn't be in that profit area at that point. Okay, so that's just another way to look at it as well, okay? And of course, yeah, you want to be always with the spread. I mean, 1 to 2 standard deviations out, that's right. Find the correct ETF for index. You can be related to the success. Yeah, and the spreads don't work if it's more than 1 strike apart. Okay, that's something I didn't realize there with some of those ratios and the other combinations. Usually, I know you're right though, but I've seen some that are funny looking to me, and I've almost traded them, but I didn't. These were standard ratio spreads. I don't think I'll be able to find one right now. No, not that one. Let me see here. No, that's not one I wanted. Anyway, I was looking at some ratio call spreads on a stock that I was in a while ago, and with the radioactive trade, straight ratio call spreads, which we talked about, not what we do, but when we're in a long stock, you can't do a ratio call spread, and it doesn't have that infinite upside risk. because one of the short calls is covered by the stock. The other one's just a bull call debit spread that they were doing. But I agree with you, Martin. If it's more than one strike apart, you very rarely can get that credit on either the back spread or the straightforward spread. But I did see one that had 50-cent strike differences on weekly options, where there was a credit at the 50-cent strike differences and the credit at the $1 strike difference, which you rarely see. There was something I was missing there that I could have taken more advantage of, because normally once you go more than one strike apart, you can't sell two and buy one and get a credit. This one you could do it technically half a strike apart and one strike apart. And there was some way to exploit that I didn't rationalize, and there probably, well, you probably could have done two ratio spreads inside of each other and got double the credit. I don't know. But you're absolutely right. Usually when you go more than one strike apart, you're not able to get a credit with doing a 2-to-1 in any combination. So that was kind of the key there. Okay, but yeah, I'm going to go through these results. We're going to refresh that webinar sometime next week. Hopefully, if I get the right numbers done, I get time to work on it. We'll look at a webinar next week, but most likely the week after that, probably before September expiration. But I want to get it done soon so we can talk about ideas of what we saw on the webinars page there, stock or portfolio insurance, which is better? Well, depends on what direction goes where, okay, as well. So we'll take a look at that next week. All right. Well, ladies and gentlemen, I didn't see any other questions coming in. So what I'm going to do is swing back over here. Oh, there we go. There we go. I just wanted to remind everyone, those of you here online, if you haven't tested out our tools yet, remember, don't go to the page that's showing you the two slides next to each other. Go to the page that's showing the right slide. And simply go to powerup.com. You can put in your first name, last name, and email address, and we'll give you access to the tools for 14 days. So you can walk through, test out the searches we looked at, brief view of the historical tools as well, and then, of course, the profit and loss charts and portfolios. Subscription services, rather inexpensive, $40 for the end of the day service, $60 for the 20-minute delayed, which also gives you access to the portfolio tools, other tools as well. And then, of course, that historical service, if you had the 20-minute delayed and access to the history, we showed the historical back test today, and we showed the historical chains a little bit. Well, that's $100 per month, but the history goes back to April of 2006. I just needed to use a month and a half of historical data to illustrate some of the movements that we saw with these also. And then, of course, we do also offer a real-time service as well. All right. And remember, other free stuff, you can check out the blog at any time, blog.powerup.com. We showed you the webinars page. The full link is powerup.com/webinars.asp. And of course, we take a look at our YouTube channel also. You can go there to see some of our free videos on the various strikes and structures as well. Okay. Well, David brings up a question, a comment here, and he says, David says, exciting times this week on OTIC covered calls. Any thoughts on protecting downside of this kind of drop? Let me take a look, because I'm not familiar with this stock and I haven't looked at it. I know there were a couple big movers this week, should say. Okay, so OTIC is at 360. Let's take a look at just big charts. What happened this week? Oh, geez. Okay. Let's go back here. 11/2, so 3 months. So it wasn't related to earnings. This was probably related to a phase 2 or phase 3 drug trial. Okay. What do you do against that kind of drop? And what do I mean by that kind of drop? Here's the thing. People get lured into these positions. I know they sometimes even come up on our searches. All right, so there it is. So on 829, let's go to 829. I could have bought stock at 2080. And let me guess, the 20 strike call or the 21 strike call was about $3. Let's take a look. Okay, so this is on 829. So on 829, it was at 2080. Okay, the 2250 calls for September were at 225, 20 at 390. Let's look at just the calls, I'm sorry. So at 390 to 560, wow, so at midpoint, you're probably looking at a 21% downside protection and a potential 20% return if assigned. Or you can even go further out of the money, maybe at midpoint and gotten higher. Okay, so when you see something that looks 5 times the normal amount of premium that you should expect, okay? When you're looking at these positions, all right, and you see something that's 5 times the amount of the premium. Now, I know, David, that probably came up as one of the picks of the day. And it shouldn't have, honestly. Just because of that alone, I think. I'll talk to Ernie about that, but this alone. But when you see something, normally what I'd expect for a 17-day trade with some reasonable volatility, not way too out of bounds. This is OTIC. Bing says, what stock is it? It's OTIC, Autonomy Inc. Okay? But in general, a 17-day at-the-money covered call, you might expect a return 2.5% to 3%, maybe 3.5%. As soon as you see something that's 5 times the amount, you know something's coming on. Okay, which means a phase 2 or phase 3 drug trial if it's not earnings. And this was probably a phase 2 or phase 3 drug trial, okay? And they killed a phase 3 trial Wednesday after failure. And that's what it was. So what happens? The stock we saw drop to $3 per share. Now, people have a misconception on these. That misconception, let me just do this real quick. Oh, I can't do it. I can't do it. I can't build the profit and loss chart because it's delisted. That's why it didn't pull up the current chain. It's been delisted because of the fail, so it doesn't even offer any more options, which is one of the risks. But I will have customers call in, and they'll say, okay, well, I see this stock. Oh, geez, guys, I'm sorry. My fault. So OTIC Bing, I apologize for that. There we go. This is the chain. So it's at 2080 on the 29th. And the 20 strike had a bid of 390 to 560. So it's a $1.70 bid-ask spread. 95 cents, excuse me. 85 cents. I was right the first time. 85 cents. So let's say we got 475. Midpoint, 2080. Which means your investment is $16. So again, you're looking at about a 20% downside protection and a 21% return if assigned, if it stayed above 20 on the 15th. Now what I was saying is the average return you should expect to see for a 17-day at-the-money trade is probably around 2.5 to 3% return. When you see something that's 5 or 6 times that, that tells you something's coming up. Something's coming up that could cause the stock to maybe gain 50% of its value. I've seen stocks like this in a day go up to $40, $42 per share, or they could drop 90% of their value and go down to $3, $1 per share, okay, which is what OTIC did. Whenever you see something that looks so outrageous, why is this one 6 times the amount? Well, it's because the implied volatility is so high that it's going to hurt the position. I mean, something's coming up that could go in your favor, but it's a 50-50 shot at this point, is really what it is. Okay, so this one drops down to $3 per share. Now, a common misconception investors have is you see something here that's offering an 18% yield, and you know your cost basis is 16, and you say, oh, well, it doesn't matter because even if the stock did drop to $5 per share, well, I could just sell the $5 call and get another 18% of $5, and I'm going to hedge this down by $2 now. No. Once that event happens, these go to 0. The at-the-money strike is probably worth 5 cents. The in-the-money strike is probably worth intrinsic value plus 5 cents. Okay? What would I have done to structure this trade? Seeing that it's 5 times the amount. Well, yeah, as Sam says, I don't like this type of spread on a bid-ask price. Yeah, no, you're absolutely right. It's a drug stock. The phase 3 failed. And again, I'm sorry I didn't show it the first time, but I've got it up here. Here's what happened. Let's go to a 5-day chart. Frequency 15 minutes, okay? There it is. At the open, Wednesday, failed, canceled, was floating right around that $20 range still, and then all of a sudden opens up just below 3, and it's just been hanging there since. There's no options anymore. It's completely delisted. All right, so It could have gone down 60, 70, 80%. I've seen these drop from $20 to $1 per share. Or it could have gone up to $40 per share. I'm not a fan of these, but again, let's say I do the 2250, and the bid ask here is about, well, this $3. Let's call it $1.50, keep the math simple. 225 bid, 520 ask. Let's say I got midpoint at 375. Knowing the risk inherent with this, I might have sold the 2250 at 375 and bought a 17.5 put. All right, I would have bought a 15 put, just looking at the numbers. So I would have sold this at 375, 2250 at 375, okay, and bought the 15. We'll have to go midpoint too. It's $2.10, $2.20. So $1.10, so that would have been $1.80 for the 15 strike. What do I have? Oh, should have gone here. Hold on 1 second, folks. Let me go back. I thought I had one here. I don't. Oh, I do. No, not really a good one. Go back to long call. I'm sorry, folks. Give me 1 second on this one. We just have to find a similar stock because I can't use that example anymore. Here. I'm doing the long call search again to find a stock. It's fine. Let me just go to September. It's okay. Perfect. Ish. Yeah, it'll be fine. I'm going to use GNL. Sorry. I'm going to use GNL. Let's go to profit and loss chart. All right. So there's your long call. But let's clear this out. Let's add 100 shares of stock at $20.80. Let's go to September. Sell the 22.5 call at 375 was our midpoint. And 1750 strike at 180. No, my apologies, it was a 15 at 180. 15 at 180. So whenever I see anything that's 4 or 5 times the average of what I'd expect to see, I'm considering that as a collar. All right, why? Because I could still make 19.4% to the upside if I'm right, but I'm only risking 20% of the investment, not 95 to the downside. Okay, that's how I would have opened it. Oh, option chain. Sorry, folks. I wanted to look at the option. I'm just curious. I know I would have had better protection, but I would have had a much lower risk on the trade. Oh, sorry. '29th, right? August 29th. That's what I needed. Yep, there we go. There's our numbers. The 1750 put 150 to 4, so it's 250. So $1.25, so 275 if I did the 17.5 put. So let's take that out, do a collar, 17.5 put at 275. Yeah, I know I'm using a different stock, but it's to illustrate what I would have done if I entered this trade, okay? 13.6 to the upside, 11.6 to the downside. So the 15 would have still had you at that 18 or 19% return getting assigned on the collar where you only could have lost 20%. This gives you closer to a 1-to-1 risk-reward ratio of a potential of making 13.6% if this was OTIC, if the stock went up and was assigned, or only a loss of 11.6% instead of 90%. So anytime I see something that's 3, 4, or 5, 3 times the average or more, and by average I should expect, maybe 1%, 0.8 to 1.2% on a weekly option, 5 days out. Let's say 1.1 to almost 2% for 2 weeks out, and about that 2.5 to 3% return if assigned at the money covered call on one of these positions, on a covered call position, if I see anything that's 3, 4, or 5 times what the normal expectation is, I'm either not trading it, I'm doing a lot of due diligence. But remember, even if you looked up OTIC, as you mentioned, David, and they said that the Phase 2 or Phase 3 trial wasn't supposed to end until September 30th, it can come out and fail any time between there. And then it drops. So even if I sold this at September 15th thinking news wasn't going to come out to September 30th, it can come out at any time before expiration. And what I thought was still a 20% downside protection and close to a 20% return if assigned now becomes an 80%, 90% loss of what I invested. You don't even want to accept that with spread trades, but you never want to accept that with doing covered calls. So David, I do apologize that you saw that. I do apologize that it popped up. But anytime you see something that looks too good to be true and is way outside the average norms you'd expect for an at-the-money or slightly in-the-money option, it usually is. And yeah, that's Sam had mentioned you got to have protective puts. Collar is my trade when I see this as well. Okay, and so yeah, Kurt's story. Tom says that's Kurt's story, right? That's what happened to him and how he developed radioactive trading also along those lines, because you can't afford to take that kind of loss with the capital invested in the covered call, no matter how good the return looks. So lack of a better term, and I don't have a catchphrase, it looks too good to be true, but you're still going to trade it, collar it up. Put a collar on it, okay? Dress it up. Put a collar around it. It'll look better. All right. All right. So that's one thing we should consider there with those kind of structures and those kind of trades as well. All right. Well, as I mentioned before, ladies and gentlemen, I think that just about covers it. So if we think of anything else later on this weekend, as always, you know, just go ahead and give me a call, send me an email, I'm sorry. You can send me an email to support@powerop.com. or to support@radioactivetrading.com. Remember, you can also reach us during market hours at 302-992-7971. Of course, you trial members and subscribers, you could schedule one of those coaching sessions at any time. And, of course, just remember everyone else, if you aren't a trial member yet, just go to powerop.com. You can register for that 14-day free trial. And at the same time, once you get a trial membership, you can schedule one of the coaching sessions to have a walkthrough with Ernie or myself. Ladies and gentlemen, thank you for your great questions. Thank you for your ideas here. We got a good plan going forward now to recreate or take a new, fresh look at our stock or portfolio insurance discussion, blogs, presentations. We'll get to that in the next upcoming week, as well as some further information for you spread traders of available features and available products that'll be there for you. So you'll see that's coming out soon too as well. Have a fantastic extended weekend. Markets are closed on Monday, so relax our brains a little bit there, a little extra day, and then we'll of course be back at it. 4-day trading week next week, and then into September we go. So take care everyone. We'll see you soon. Good night.